Are interest rates setting up for another downturn? Rates are down from where they were in the middle of January, and so the trend is now more than a month in length. And what it suggests is that the market is becoming more comfortable with a whole bunch of things, starting with the position of the Federal Reserve, as well as where the economy might be developing. And this week has been a pretty good microcosm of all of these different factors being thrown together. We started out, or at least in the middle of the week, we got the consumer price index numbers, which everybody said were scorching red hot. And they send yields soaring higher because the Federal Reserve might interpret them as inflationary, therefore less potential for rate cuts, more potential maybe for even a rate hike. Some people were even talking about that. But then the very next day, the producer price index comes out and on its face looked to be just as red hot as the CPI, except interest rates were sent lower because parts of the PPI suggested the CPI was overdone. And so what we're really talking about in terms of the PPI and CPI is really the market trying to make sense of how the Federal Reserve is going to interpret the data. And then we finish out the week with some pretty bad retail sales figures, which sent rates down even further. So for all the back and forth, including a couple of auctions, 10-year auction, 10-year note auction, the 30-year long bond auction that the media characterized as poor, bad, not really good, despite everything that happened this week, interest rates are actually lower on the week. So consumer prices, inflationary, producer prices, inflationary, auctions, deficits, all of those things, and rates are going lower, suggesting that the market may be setting up for another downturn here, at least in the short run. It's difficult to tell on the short run basis, but we've got all the key ingredients, including the implications of what we're in retail sales, which is what ultimately matters when it comes to interest rates. It's not really about the Fed so much outside of the short run. It's not about deficits. We wish it was, but it's not about deficits. The fundamentals I'm talking about are, as always, as you know, Steve, Mr. Van Meter, growth and inflation expectations, right? It's not about supply. It's not about a monetary policy or interest rate policy from central bank. It's about the market saying the economy sucks or it looks like it's getting better. And unfortunately, the market for the marketplace, and unfortunately for us, the marketplace is saying we're still in the sucks category.
Yeah, Jeff, and that's a challenge because when people look at the rates market, they want to say it's based on all of these factors, right? The Fed or, Treasury auctions or all the number of things that you just mentioned. But in the end of the day, it comes down to exactly the two issues you mentioned, growth and inflation expectations. Right now, the market obviously thinking inflation is going to go higher. And I think, over the next couple of months, it probably is going to go higher. The issue then is it should be the growth component. And that's a big factor here because if you look at the goal of the Trump administration, it's clearly pro-growth. And that's going to lead to inflation because if you get growth, you should get inflation. And right now, I think what the market's kind of telling us is, yeah, we think inflation could go higher here, but we don't think that's because growth isn't going to come along. We think growth is going to trend lower. That's why we're seeing that knee-jerk reaction today, at least on the retail sales data, that tells us rates got to go down because growth, clearly from the consumer's perspective, slowing down.
Yeah, we were talking about this a little bit earlier. The Treasury Secretary, Mr. Bessent, the hedge fund manager, saying that he wanted the 10-year yield. When President Trump talked about interest rates going lower, when was that? A couple of weeks ago. Clarifying those comments, the Treasury Secretary said, no, we didn't mean the Fed. We're not talking about the Fed. We're not interfering with their independence or so-called independence. What we mean is we want the 10-year Treasury yield to go down. And both you and I, Steve, were shaking our heads like, no, you don't want the Treasury yield to go down. And you can understand what he was saying from a couple of different perspectives. The first one, from the perspective as a Treasury Secretary, you would love lower interest rates because it lowers your interest costs. So, I mean, that one makes sense. But you have to think much broader than that. And he was actually, what he was saying was that if we get our, what did he say? Low inflation, pro growth policy or proflation policy, however he characterized it. What he said is if we get that right, then interest rates are going to go down. If we get inflation numbers to go down, then interest rates should go down too. And if that, thinking like an economist, ceteris paribus, if that was the only variable here, then yeah, you would expect, okay, the market has lower inflation expectations, therefore interest rates can fall. But that's not how this works, nor is that what we want. Because if the market was perceiving lower inflation potential, as you just said, Steve, that would also mean higher growth potential. So if the market thought that these inflation fighting policies, pro growth policies, were at all going to be effective at the long run, and remember, we're talking about probabilities here. The probability was rising that these would be effective. What would happen is that, as you just stated, growth expectations would rise. So even as the inflation expectations go down, growth expectations rise even more than inflation expectations go down, and interest rates overall go up. And if they do, you don't say, oh crap, they're going up. You say, see, the market sees it too. You celebrate higher interest rates. So when you put all these things together, the fact that rates are not soaring here is actually a bad sign, not a good sign. It's not really about inflation. It's the growth side of the equation that we need to get going.
Yeah, absolutely, Jeff. And I'm baffled by a lot of comments Basent has made because, he's a hedge fund manager. He
Well,
manages.
that's the answer right there, I think, right? I mean, this is how they look at interest rates on Wall Street.
Right, but that's the problem is you think, okay, maybe we got a guy that's coming in here that would say, hey, you know what? I know what the mainstream view is, but I've made a lot of money in the bond market. Let me tell you how it really works and what we really need to happen. And one of the first things he came out and said is, we issue too many T-bills. And I'm like, no, do you understand that their financial system is completely collateralized by T-bills? We need more of them, not less of them. And then when he came out, just like you said, hey, we need the 10-year treasury yield to go down. I'm like, wait, what are you saying here? Like, do you not get it? And he kind of is buying into the same mantra as the Fed wants you to believe that, hey, if growth slows down, we just need lower interest rates because for some reason, 0.25% interest rate or maybe a change on the 10-year, the average American household is sitting there looking at their spending desires over the next year and be like, man, honey, if only the 10-year treasury would just come down a little bit, we could go out and buy that new RV or that toy hauler or car, whatever it is we want to buy. But Jeff, no family ever in the history of this country has ever had that conversation. And yet here he is coming up and saying, like, I'm clueless about how this whole system works, but if we just had lower rates, everything would get better. But Jeff, we know that if rates do go down, they're going to panic because it's telling us that growth and inflation expectations aren't just coming down, that the economy is already on that path.
Yeah, it isn't changing, right? It's the same path as before. In fact, you look at the last couple of years, despite the fact that the federal government went completely crazy insane with debt issuance, and we spent the last couple of years every month when the 30-year long bond was auctioned off, we got to hear about how it was horrific, it was bad, it was going to lead to the unleashing of bond vigilantism. And every month that it happened, the 30-year Treasury Secondary market never paid any attention to any of that. So over the last couple of years, really going back to 2022, when the market stopped following the Federal Reserve and rate hikes at the front end of the curve, what the market has been saying all along, with rates that are basically sideways to lower for almost, we're talking about 2.5 years, what the market is saying is that we don't see inflation spiking up and staying that way. Sure, there'll be back and forth along the way, as there isn't anything. Nothing ever goes in a straight line. But more importantly, as that disinflationary process was developed and was expected to continue in the marketplace, it was not being replaced by higher growth expectations. That's the real key part. We should have seen rates rising apart from the Federal Reserve. Instead, rates were fighting the Fed the entire way because the market was saying, we see the disinflation, but we don't see the growth that should be going with it. And that's with everything that was supposed to have changed over the last couple months. The market is saying, I don't really see any change. I don't see any change from the economic perspective or, data dependency from the Fed and how they're going to interpret all this information too. We don't see that changing either. So even if the CPI was hot this week, it wasn't inflationary. It was just a bunch of one-off factors that, stuff that we talk about all the time, like auto insurance premiums. We talked about that last year, right? Auto insurance premiums spiked up in January of 2024. It didn't lead to inflation. It led to more economic hardship because that's what ultimately the bond market is saying. With everything that happens, more often than not, it contributes to the hardship rather than fixing it. The economy that forgot how to grow is a topic they cover quite extensively in all the different facets of it at Eurodollar University's Deep Dive Analysis. For the next couple days, just through Tuesday, we're having a short-run President's Day sale on the Deep Dive Analysis, on Eurodollar University memberships, and the daily briefing, especially when you bundle them all together. One really incredibly low price just for the next couple of days. Check out Eurodollar.university for all the information on our subscriptions as well as these sale prices. Next couple days only.
Jeff, you made a great point. You look at the inflation data, and what are you looking for? Growth or no growth? What are you going to get? And, in the past, it was always like, okay, hey, if inflation comes down, that means you're going to get growth. But what you're seeing right now is, okay, inflation's going up, but growth is going down. And that's the real issue here is the bond market is saying, hey, look, we know a lot of you are probably short these positions because you think rates are going up and you think, the auctions are bad and you think the Treasury Secretary is going to do who knows what. Maybe the government's going to run big deficits. But in the end of the day, higher inflation is not leading to growth. In fact, what it's doing is the exact opposite because what do we know? Average hourly earnings, while it is above inflation, it's not above enough. Hours worked are getting cut. We're seeing people go on unemployment and get stuck there. So inflation now is becoming a headwind to the economy and not signaling growth. And that's exactly what the bond market's trying to tell everybody is, look, you think inflation should lead to growth, and normally it should, but now it's not. And there's a price to pay. That means the expectation is, yes, inflation could go up in the coming months, could be very transitory. We could get a spike, but then at some point, based on what we're seeing right now, it's going to reverse in a big way.
Every time it goes up, that's the thing. Every single time it goes up, the CPI accelerates on a short run basis. It's like you can set your watch to it. The economy is going to slow down as a result, not pick up. And it's supposed to be the other. I think that's it, right, Steve? That we got the order wrong. We see consumer prices start to rise, not spike up, not surge, but they tend to rise more, in a more sustained, gentle fashion after the economy picks up first. You get a rush of, activity. The labor market, we've talked about hours being cut for how long now. So companies start working their workers a little bit more. Hours pick up, paychecks start to pick up, demand overall starts to pick up, and then consumer prices pick up. That's how it's supposed to go. Instead, what we see is consumer prices pick up for reasons that have nothing to do with the general economy, which then causes businesses to start cutting hours more because if oil prices spike up, that's a cost that they can't absorb. And because the economy is weak, they can't pass that along to their customers. So what happens? They have to cut their costs somewhere, so they cut back on hours. Some of them, like Chevron says, you know what? We got to cut 1/5 of our entire global workforce because it's just not working for us. That's backwards. That's not how the economics of a recovery work. And if we saw the economics of the recovery start to rearrange themselves in the right order, that's where we would see interest rates starting to go up, and we would all be happy about it. It's one of the things that we always say. We're not bond bulls here. We don't want interest rates to go down. We want interest rates to go up because that would be the market saying we finally see the end of the light here, the end of the tunnel here, and it's not a freight train coming at us.
Right, Jeff. And what we're saying is if you look at the economic fundamentals and you look at all the data, what you find out is that rates should be going down. And that's not exactly, as you just said, it's not a good thing. It's not what we want here. But there's a big challenge. What we see going on in the broad economy is further slowdowns. You mentioned, again, where does inflation come from? Because if you take a business owner and they've got inventory and customers are coming in and buying it, they don't think, hey, you know what, I should just raise my prices because, hey, there's demand here. They don't do that. What they do is they start saying, hey, they go to the wholesaler and say, look, I need more inventory. I got tons of business. Send me more stuff. And then the wholesaler finds out that a bunch of retailers are getting demand. So they go to the factory and say, hey, we need more. And next thing you know, the factory is saying, we can't produce more, so we're going to have to raise our prices. We're seeing our input costs go up as demand rises, and then it shows up in the inflation data. And as you pointed out, right now we're seeing the inflation data and not in the rest of the economy. And that's exactly why we see things like what the New York Fed came out just the other day and said, look, delinquency rates are rising. Big red flag for the economy, because again, it's not about inflation, because if wages were going up enough and there were enough jobs being created, people could afford higher prices. They could afford higher interest rates. But you look at what the bond market is saying, and then you look at the delinquency rates and you go like, hey, things aren't getting better. They're getting worse, and they're going to get a lot worse unless that trend changes and changes fast. And there's nothing we're seeing that's going to do that.
Yeah, I'm glad you brought up delinquencies, because that's another topic that's worth really investigating too. Delinquencies continue to rise, especially in autos and credit card loans, but also we've seen a rise in mortgage delinquencies too, which is pretty concerning. Well, mortgage delinquencies were historically low in the 2020s. That's largely because banks and mortgage providers wouldn't give mortgages to basically anybody unless you had a perfect credit score. So the amount of mortgages that are floating around in the real economy have shrunk substantially in proportion to the overall economy since 2008. So banks have really cleaned up their act as where mortgages are coming from. Suddenly, mortgage rates really went down, or mortgage delinquency rates really went down in the early 2020s after the government stimulus and everything else. Now they're starting to pick back up again, and banks are thinking, well, mortgages that were historically low delinquencies, this isn't normalization. We weren't giving out a whole lot of mortgages to a lot of people. Now all of a sudden delinquencies are going up, bad loans are going up. What does that tell us about the cyclical nature of the economy? And it gets back into what we were just talking about, interest rates. This is a factor that the bond market is factoring, which is saying, okay, the Fed is cutting rates, which if you believe that rate cuts do something, it means that it makes it cheaper to borrow. Fine, maybe it makes it cheaper to borrow, but banks don't want to lend when interest rates are going down, because that means that the economic fundamentals are bad, which means delinquencies are rising. So even if interest rates are going down and stimulating demand for loans, there isn't going to be a supply of lending, which exactly what we've seen from the banking system, because the banking system is saying it's more risky to lend now than anything else. So low rates get canceled out by the fact that the economic fundamentals aren't there for them. So the bond market is taking that into account. It's the same thing with industrial production and retail sales. All the economic data that continues to come in and suggest we keep getting this back and forth. At best, the economy goes nowhere, which is the opposite of growth. So you put that together with the delinquencies, with credit conditions, and it looks like, the bond market continues to say we don't see the growth component, which we would like to see it. And we would see it if anything was being effective at sparking growth, whether it be lower interest rates or some pickup in the labor market or something else.
Jeff, I'm glad you mentioned autos, because we talk about, subprime houses back during the global financial crisis. And what did the New York Fed say? Hey, there's kind of, this noticeable trend that a lot of people are upside down on their vehicles. And, it's one thing to say, I'm going to give the keys to my house back to the bank because at some point I might not have a place to live. But if you have more than one vehicle, and most households do, it's pretty easy to be like, hey, you want to come repo my car? Please take it. And what we're going to find out is a lot of banks, particularly small, community banks, credit unions, they lend a ton of money on cars. That's their business model. And what they're going to find out is their parking lot's going to turn into a used car lot, and they're going to be upside down. This is potentially what we're seeing as another financial crisis just building up in the automobile industry. And then when we looked at the industrial production data, hey, what a shock. Auto sales are plummeting. What do you know? It's kind of interesting that we have an oversupply of vehicles here. But again, you mentioned the banks. Lower interest rates. Everyone says, hey, that's going to be a big boom for lending, but it never is, because if you think about it from a business perspective, if I said, Jeff, I'm going to take your business, I'm going to cut your margins. And by the way, every time you sell something, if any one of those comes back or too many start to come back, your whole business fails because you have to eat the loss personally. Well, that's the bank situation. The problem is, as you said, they only lent to the people they knew they could pay it back because the margin for failure is that small for the banks. They don't want lower rates. They want higher rates. Bond market telling us very clearly something is wrong with this economy. And despite the fact that everybody wants to see it turn around, they want the soft landing, they want to see the growth, the bottom line is a bond market saying whatever you're seeing that looks good is only transitory.
If we were going to see all of those signs of a turnaround, we would have seen them this week, right? Everything that could possibly have gone wrong bond market wise, or at least what everybody assumes, bad auctions, which by the way, they were not actually bad. There are no bad auctions, but they said there were bad auctions. We got PPI, which was elevated. The CPI was well above expectations, and everybody's screaming and shouting about inflation. So if pro-growth policies and strong economy, the labor market, the Fed may be having to talk about rate hikes, and basically everything that was supposed to go wrong for the bond market that could have gone wrong did. And yet rates are trending lower here, at least in the short run. And on top of the fact they've been trending the same way for the last couple of years, despite everything that's happened along the way, it's a pretty convincing case of not Treasury debt, not Treasury secretaries, but growth in inflation expectations. Low growth more than anything else. I think that has to be the greatest racket in anything, right? We're going to appoint you an independent agency, and part of your job is to tell us how you think you did.
Yeah.
And twice a year, you come up here and tell us how you think you did. And where are they ever going to say, well, we did really poorly this quarter?
Right, exactly. Or be like, Hey, that banking back in March a couple years ago. Did you ever find someone